Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blickery joining us here to break it all down. Jared.
Bunch of records to discuss, not in the Dow. We'll start with that. Really just couldn't get off the dime today, and you can see in the intraday price action, well, slightly green on the open, but pretty much in the red, but not a lot most of the day. The real action was in tech, where we had that AMD move. Really great day for that, almost the best in a decade for AMD, but we'll focus on the indices right now. So the Nasdaq up 0.7%, S&P 500, very green chart, up about half of that. And the Russell 2000, also a record closing high, in addition to the Nasdaq and the S&P 500. On that note, we will go to the sector action, where we see tech has been in the forefront all day long, up about 1% on the close. Close behind is utilities, that other part of the AI trade, and then consumer discretionary. We'll take a look at Tesla in a second. That was really powering that move. And then energy and industrials also rounding out the top five there, and also all of those outperforming. Real estate didn't do too well today. Neither did staples, neither did healthcare, but those are defensive sectors, so not surprising to see those. We're not concerning for the bullish picture on a day when we really saw a lot of records. Now, looking at the Nasdaq 100, you see NVIDIA down in the upper left, biggest stock down 1%, but that is just because the flip side of the NVIDIA AMD trade, guess what? AMD up 23%. Huge day for AMD. Also Tesla up 5%. And let's just check out the year-to-date on that real quickly, because that only turned into the green a few weeks ago, and it is up now 12% on the year. Microsoft and Alphabet, each of those up more than 2%. So the mega caps really doing well today. And inside the semiconductors, all right, we got some red there because of some of the big names in the red, but you take a look at the equal weighted AMD number one, Supermicro up 5, Taiwan Semi up 3, so is KLA, Marvell, and the list goes on. And even in software looking very bullish as well. Not only the big, but a lot of the smaller names. And I will show you disruption. So Tesla, we saw that earlier. I'll put on the equal weight so you can see some of the smaller names, but a lot more green than red looking in the disruption trade. On that note, I will send it back to you, Josh.
All right, thank you, Jared. Appreciate it. Well, markets holding near record highs here as tech and innovation keep powering this bull run, but some fatigue setting in. Joining us now is Ross Mayfield, investment strategist at Baird, for his read on what is next. Ross, great to see you as always. Markets don't seem too concerned, Ross, about this government shutdown. I did see Ed Yardeni, Ross. Now, he's a well-known guy, right? He raised his year-end S&P 500 target, Ross. He goes back to 7,000. So Dr. Ed sounds constructive. You agree with that call, Ross? Does that sound reasonable to you?
Yeah, I like the optimism. I mean, obviously the market shrugging off, the shutdown is maybe not unexpected, right? These have not been big market or economic events historically. We could still get there, if we follow through on some of the threats for firing, the economic, the data, the labor market is already in kind of a soft spot. But as far as what's driving the bull market, the innovation trade, as we just heard, tech, nothing is slowing that down in the near term. Things feel a little bit tired under the surface right now, but it would be perfectly normal for the market to consolidate here in the next couple of weeks and have one of those classic Santa Claus rallies into year end. So would it be surprising at all to make a push towards 7,000? I don't think so at all.
Talking tech, Ross, I don't know if you saw these comments from Paul Tudor Jones, told CNBC today, Ross, said today's market domination, talking about how it's kind of reminiscent of the setup leading up to the burst of the dot-com bubble in 99. What do you make of those comments?
I don't think we should be all that surprised. I mean, his comments were, yes, it looks a lot like the late 90s, but this bull market could still have plenty of room to run. I mean, this is the history of the stock market, right? Booms and busts, right? It's never up in a straight line. You get, these super cycles that then you get overbuilding, over enthusiasm. Ultimately, then, you're paying too much for a share of earnings. It looks a lot more like dot-com bubble because it's tech at the center, but this is the history of the stock market, for the last 150 years. It was the railroads in the 1800s and autos and So this is not all that surprising. I think we're more in the middle innings than we are in the later innings of any sort of bull market into bubble transformation. I think there's still plenty of strong fundamentals in earnings. I don't see the kind of sentiment that usually comes with a blow off top, right? Even comparing today to 2021, 2021 felt way more bubbly to me, just anecdotally in terms of sentiment. So, I agree with the general sense, but I don't think that should be all that surprising. That's just kind of the history of equity markets here.
How would you characterize valuations here broadly, Ross? How stretched are we?
Expensive, but not crazily so. I mean, the thing that's so different about now versus late 90s, and this is not an original point, but is that a lot of these companies that are at the top of the market, the big ones that have all this price momentum, most of them are really solid companies with strong earning streams, big moats around their businesses, and even the ones that are starting to invest a lot and spend a lot more than they had historically have these other businesses off to the side, right? If it's, maybe it's Meta with its ad business, so they can spend, on AI infrastructure because they have this core business that is just churning off cash. So valuations are stretched, but if you look at the S&P equal weight, it's something like 16, 17 forward earnings. I mean, it's expensive relative to history, but not so much so that you can't get into the market here. I don't think we know how valuation works as a short-term timing tool anyway, which is not good at all. So I don't think it's a concern yet, but it's something to keep an eye on, obviously.
What about this upcoming earnings season, Ross? Your expectations there? Is this going to be another catalyst for the market?
Yeah, I think so. I mean, look, you've got this market that's being driven by excitement around a theme. But again, it's being backed up by earnings. So every time you have one of these big companies come through and have, like an Oracle moment from a couple weeks back, that just blows expectations out of the water, it kind of gives more fuel to this fire. Now, again, could it ultimately, inflate into a bubble and pop somewhere down the road? Yes, but right now the earnings are strong, and it's not just tech. I mean, if you look at the financials, the industrials. I mean, this theme is kind of spreading through the market. And then on the flip side, the tariff bite has just not come yet. You've got profit margins for the S&P pushing towards all-time highs. You just have to stand back and marvel at the ability of U.S. companies to squeeze profit out of this kind of global economic situation, right? And it's pretty good, not just in the U.S. but abroad. And I think that's the thing that gets underlooked a little bit is, we're an economy of multinational companies, and outside of the U.S. is doing pretty well right now. Europe, Japan, China, there are places where a weak dollar is really helping juice profits. So I think it's more than just tech, but I'm excited for what I think is going to be a really nice earnings season here and another expectation beating earnings season.
Big picture, Ross. How do I want to be positioned in this stock market right here? What am I screening for?
Yeah, I do think all that enthusiasm said, I do think you continue to screen for large cap and quality over chasing any sort of speculative rally. I know small caps have popped on this rate news. I still think large caps are the favorite here, both because of the kind of spend and capital, building that you need to participate in AI. But also because I don't think rates are headed that much lower. I mean, the Fed is going to keep cutting, but we're in a higher for longer rate environment. We are not, in my opinion, returning to a 2010s kind of zero interest rate policy environment. I think the deglobalization and kind of the fiscal dominance narratives are too strong. So you've got higher for longer rates. You've got all this input cost inflation. I think it still is a really difficult operating environment for smaller cap companies. So I think you lean large cap, you lean high quality cyclicals. Again, I don't want to be chasing companies that aren't earning a profit, that don't spit off cash flow, because I think you need that to participate in this AI, kind of build out cycle, to retain your labor, to get a leg up. So I think you can give up a few points to the upside by sticking with high quality and large cap, but I'm willing to do that because I think that's how you survive the full cycle.
Ross, great to see you as always. Thank you.
Thank you.
Was a major move in regional banking. Fifth Third is buying Comerica in a $10.9 billion all-stock deal, creating a huge bank with nearly $290 billion in assets. It's the biggest U.S. bank merger of the year and a sign of more consolidation to come. Banking reporter David Hollerath joins us now with more. David, good to see you. So maybe start a big picture. Give us the context, David. How big a bank deal would this be?
Yeah, so as you pointed out, it's the biggest deal announced so far this year. It would also be the biggest bank merger deal in nearly 3 years. But what's even more interesting to me is the fact that it's another proof point in the acceleration of bank merger deals this year. This has been talked about for a number of years, basically since 2023, and before that, going as far back as just following the financial crisis, so decades. And really, what has changed here has been the fact that we've seen bank multiples stay depressed while some of their stocks have gained some since the 2023 regional crisis, which really is what sets the scene here for why regional banks are merging in a bigger way.
What do we think regulators, how do we think they react to this headline?
I don't know how regulators react to this headline, but I think we've already seen mergers pass pretty quickly. And I spoke with the CEO of Fifth Third and Comerica today, and they both indicated that they feel good about the regulatory environment for bank mergers. Regulators have also adjusted their guidance on bank merger policy, essentially kind of reverting away from the Biden era, what Biden era regulators sort of set out, which was kind of seen as more onerous and not really encouraging banks to merge.
When you spoke to those CEOs, I'm curious, they explained the strategic rationale for this.
Yeah.
What did they say? How did they put it?
Yeah, it's very simple. It's a matter of scale in regional banking because of the regulatory costs, the technology costs, and some other things like marketing costs. It makes a lot of sense in banking to have a bigger size. Now, that being said, size isn't good enough in itself. Like, you don't want to just get bigger, you have to be strategic about it. And both these banks had branch footprints that were distinctly different, although they had some overlap geographically. The other key thing here is that Comerica is primarily a commercial bank, so they have a lot of large commercial bank deposits, do a lot of large commercial loans, whereas Fifth Third has a little bit more of a diversified business. Comerica needed that because retail deposits are typically the most sticky funding source for banks in the industry. So between that, it was a pretty good match. And Comerica actually, for a while, has kind of been a target as a potential acquisition target for a number of banks.
How would you characterize just the general environment for regional banks this year?
So again, if we look back to the 2023 period where there were a number of regional bank failures, we've kind of seen the industry in recovery mode since then. And this year, their margins have been improving as interest rates have sort of normalized. And with interest rates coming, or the Fed lowering its policy benchmark short-term rate, we're expected to see that continue. So the outlook looks generally pretty good.
All right, David, thank you, sir. Appreciate it. Gold continues to shine as the precious metal approaches 4,000 in a record-setting run. For a closer look at commodities, let's welcome in here Robert Minter, Director of ETF Investment Strategy at Aberdeen Investments. Bob, it is good to see you. So maybe take a step back and help us explain this run we've seen in gold. What is driving this, Bob? Is this central bank buying, rate cuts, safe haven? What do you think?
Well, it's a little bit of all the above, but 75% of the move we've had so far really has been from central banks, and that's key in figuring when we plan for what's ahead. And the investor class, which is separate, of course, from the central banks. Central banks are long-term buyers, and the investor class tends to be more fickle. In June, we saw an impending upside in that investor demand because the Fed really needed to cut rates closer down to the 2-year Treasury yield. The 2-year Treasury yield is typically where you see Fed funds rates, and then the Fed, of course, adjusts above or below that, depending on whether they want to tighten conditions or loosen conditions.
I'm sorry, go ahead, Bob. Finish your thought.
Sure. So that's actually what happened is the Fed's eventually signaled lower rates, and so that led to a little buying demand on the investor side for gold.
What about the government shutdown, Bob? What, if any, impact do you think that could be having?
So I actually think that the government shutdown is less of a driver than I would say maybe some some miscues on interference with the Federal Reserve. You typically, if the executive branch doesn't quite agree with the Federal Reserve policy, you tend to send your Treasury Secretary over to have a little discussion and say, well, this is the data that I see. How come you don't see it the same way? And compare data sources. They actually both have been in the same camp, which is they've been relying on the BLS data, which has been, really low survey results. I think less than 30% of the surveys that are sent out are actually returned, and which is a dramatic drop. So they're having to fill in the gaps, and that means that there's really large revisions that are happening. So it means both President Trump and Chairman Powell are making decisions based off of bad data. So, but what we think is adding to this demand for gold is you typically don't see this kind of interference from the executive branch onto the policy branch of the Federal Reserve.
I'm curious, Bob, what do ETF flows, what have they been looking like? Did you see a pickup in September?
We saw a pickup in September, and we saw a pickup last year in June ahead of the first September cuts. So, and it certainly has gone north from there so far this year, after it became very clear that the Fed was going to need to cut.
So what is your target for gold, Bob? What are you looking for, near to intermediate term?
Well, we keep blowing through targets, so it's a revolving door target a little bit, and so we had a 4,000 target. We're really close to hitting that, and so we could see 4,200 by the end of the first or second quarter of 2026. And I think maybe a better tell is don't try and get too cute with this and try and pick a top. Use something like a 100-day moving average for gold. It's signaled really good support levels. And if you break the 100-day moving average, then maybe reconsider, take a little off the table. But for now, it's all systems go.
All systems go. Having said that, Bob, if I pressed you, I said, okay, but what are some near-term risks for gold investors they should think about? What would you say?
That's actually a really great question, and we've been looking at it from that point of view too. The most negative thing that could happen is something would deter these central banks from their continued support and continued long-term demand. And so it's important to understand their motivation in these long-term purchases, and that's the absolute explosion of government debt across the world. And we went back, it's typically three ways you can value gold. One is with the inverse real yield. So like take a 10-year TIPS yield, invert it. That points to gold at like $1,000 an ounce. That's not going to happen because of the second way you can value gold, which is using the all-in sustaining costs of the miners. It's obviously a spectrum, but it averages out to between $1,500 and $1,600 an ounce. Clearly, we're way over that, which means gold miners have some really great margins. The third way is to go back to, and in this case, I used 1998 and looked at the increase in U.S. government debt and the increase in the gold price. And both of them are up about 1,000% since then. So then I went and looked at the explosion of the balance sheets in the developed markets, the Bank of Japan, the PBOC, obviously the Fed and the ECB, and they're all up about 1,000% too. So it raises the question, which a lot of consumers have sympathy with, which is it that gold is more valuable, or is it that the currency we're valuing these metals in is just worth less?
Bob, great to see you. Appreciate it.
Great. Thanks for having me.
Well, despite recent strength in the IPO market, more companies are choosing to stay private longer. Yahoo Finance spoke with Hamilton Lane co-CEO Eric Hirsch about changes in the private market.
I think what you're seeing is this is a sort of typical maturation and an evolution, which is if we go back a couple of decades, people wanted to be public. That was the hallmark, that was the stamp of success. That told your customers and your competitors that you had made it. That's no longer true today. So today, the number of public companies has generally been trending down and to the right for the last several decades, and there's a few reasons for that. It's expensive, time-consuming, and all of that to be a public company. I know, we are one. But it's also the fact that the private markets have continued to develop, mature, and grow to a point where there's adequate capital to allow you to stay private for as long as you want to.
And do you see any kind of change to that equation?
I don't. I think, frankly, this is just giving choice to the market. If you want to be public, and by the way, again, we made that strategic decision several years ago because we saw some real strategic advantages for Hamilton Lane to be public. But if you don't see those advantages, or you frankly see more advantage in being private and having private capital, private partners helping you grow, then you've got the optionality to do that. I think this is a good thing. It's not a great thing for the public markets because, again, there's just less choice going over there. But I think it's a good thing for companies to be able to chart their own path depending on which one makes the most sense for them.
Well, and it's also maybe one of the things that is less good is that most investors, the vast majority of investors, don't have access to the private markets, right? They can't invest in OpenAI. That maybe seems to be changing a little bit. Do you think it is going to change, and how quickly is that going to happen?
So I agree with you that has been a real downside for individual investors. If you're not part of a pension plan where frankly, a lot of those returns are coming from the private markets, you've basically been left out and left behind. That is changing. So with the advent of a series of products referred to commonly as evergreen funds, private markets are now being much more accessible to the mass affluent. That's still not everybody, but it's a big step forward for people with a couple $1 million net worth, and there's a lot of those people, as we know, in the United States, but that is happening now. And if you look at the exposure for that customer base, it's basically 0%. But the change is here, the change is coming, and I think it's going to occur very rapidly. The next question then tends to be, do you think we're going to get that private market access moved into the 401k market? And I think that's a different question.
What's your answer to that question, Eric?
I think we will eventually, but I think we're going to see more. We need more than simply an executive order or the administration saying, hey, let's make this happen. I think you're going to see real regulatory reform required in order for that to happen in a way that makes sense for the consumer of that product and the provider of that product.
I want to switch gears and just ask you as well about something that's been going on in the news, and that's the government shutdown. Because I know it's something you're watching, but I'm curious specifically. We've had the IPO window finally open back up, a number of IPOs. That allows exits for firms like yours and stuff you've invested in. With the SEC, presumably on furlough like everybody else, does that run the risk of sort of slowing down that momentum?
I think this is a question of duration. My own view is that we're going to see this likely get resolved this week. But if I'm wrong and this stretches for weeks or longer, then I think you're going to see ripple effect. I think right now the market is telling you that they also believe this is going to get wrapped up and resolved in relatively near term. But again, if that proves to be incorrect as we sort of see what happens or doesn't happen this week, then I think you are going to see ripple effects, not just simply from the SEC, but we're going to start to see some ripple effects across other broader parts of the economy.
All right, time now for what to watch Tuesday, October 7th. We're going to start off on the Federal Reserve. We're getting a big batch of commentary on Tuesday, including the central bank's newest edition. That would be Fed Governor Stephen Myron. This is coming after comments from New York Fed President John Williams on Friday. Williams saying that the Fed must prepare for the unexpected and citing artificial intelligence and innovations in financial systems as a cause for unpredictability. Taking a look at earnings, American food company McCormick reporting results for the third quarter on Tuesday before the markets open. Analysts expecting McCormick sales to pick up in the Q3, driven by stronger demand from its consumer products and better pricing in its flavoring business. And shifting gears to Tesla posting a teaser video on X, sparking speculation that the EV maker could be gearing up to release a new car. The video showing a spinning component with the Tesla logo on it and ending with the numbers 10-7. And finally, Amazon Prime Big Deal Days is starting on Tuesday. The two-day event for Amazon Prime members features discounts on millions of items and will be another gauge on the consumer as we head into the holiday shopping season. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. We've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.